Welcome to the world of inventory valuation, where numbers tell stories and decisions shape the future of businesses like Mr. Fix Auto. Today, we're diving deep into a crucial accounting principle that can make or break a company's financial health, the lower of cost or market rule, or LCM for short. Now, don't let the jargon scare you off. I promise this will be engaging, relatable, and informative. So, buckle up. Imagine you're running a reputable auto parts company, Mr. Fix Auto, known for its quality car batteries. You've just stocked up on 100 batteries, paying a solid $50 each. That's a total investment of $5,000. At this point, everything looks rosy. You've got a healthy inventory, and your balance sheet is gleaming. But hold on. Market conditions can change faster than a car zooming down the highway. Now, let's talk about what happens when the market price of car batteries takes a nosedive, dropping to $40 each. Ouch! That's a significant drop from your initial cost. This is where the lower of cost or market rule comes into play. It's not just a dry accounting term, it's a lifeline for businesses like Mr. Fix Auto. This rule tells you to value your inventory at the lower of what you paid for it or what it's currently worth in the market. So instead of reporting your batteries at $50 each, you have to adjust that to $40. Yes, it hurts a little, but it's about being realistic. Why is this adjustment so important? Well, accurate inventory valuation is vital for a host of reasons. First off, it directly impacts your financial statements. If you overstate your inventory, you're essentially telling the world that your company is worth more than it really is. This can mislead investors, lenders, and even your own team when it comes to making strategic decisions. Who wants to be that company that looks good on paper, but is struggling behind the scenes? Let's break it down further. By applying the lower of cost or market rule, Mr. Fix Auto ensures that its inventory reflects the current market conditions. This prevents overstatement and gives a more accurate picture of the company's financial position. It's like looking in a mirror. What you see should be true to life. If you're standing there with a smudge on your face, you're not going to feel great about it, right? The same goes for financial reporting. Now, what happens on the balance sheet when you adjust your inventory? Instead of showing that $5,000 investment in batteries, you'll now show $4,000, reflecting the lower market value. This adjustment is crucial because it gives stakeholders a clearer view of what you actually have in stock. Transparency is key in business, and this is one way to maintain it. Moving on to the income statement, this is where the real drama unfolds. When you lower the inventory value, it affects your cost of goods sold, or COGS. In our example, by valuing each battery at $40, your COGS increases, which means your gross profit takes a hit. It's a tough pill to swallow, but it's essential for accurate profitability analysis. If you don't reflect these losses, you might make decisions based on inflated profits, leading your business down a slippery slope. Let's talk about losses for a minute. When Mr. Fix Auto recognizes that it's lost $10 per battery, thanks to that market drop, it has to acknowledge that loss in its financial statements. Multiply that by the 100 batteries, and you're looking at a $1,000 loss. This recognition is crucial because it impacts your net income. By honestly reporting these losses, you're not just being transparent. You're also setting the stage for better decision-making in the future. You can't fix what you don't acknowledge. Now, you might be wondering why all this matters. Well, for businesses like Mr. Fix Auto, adhering to the lower of cost or market rule isn't just about following accounting standards. It's about maintaining credibility and trust. Investors and creditors want to know that you're not just playing with numbers. They want assurance that you're making informed decisions based on real data. By being upfront about inventory valuation, you're enhancing your company's transparency and integrity. Let's take a moment to reflect on the broader implications of this rule. It's not just about car batteries. It applies to all types of inventory: raw materials, work in progress, finished goods. Essentially, If you're in an industry where inventory values fluctuate, this principle is your best friend. It helps you keep your financials in check and your business on the right track. So, what's the takeaway here? The lower of cost or market rule is a vital accounting principle that ensures businesses, like Mr. Fix Auto, accurately value their inventory. It helps prevent overstatement, reflects current market conditions, and ultimately contributes to better financial decision-making. By applying this rule, companies can navigate the complexities of market fluctuations with confidence. As we wrap up, remember that every number on the balance sheet and income statement tells a story. By valuing your inventory realistically, you're not just keeping the books straight, you're paving the way for future success. Whether you're a business owner, an aspiring accountant, or just someone curious about the world of finance, understanding these principles can empower you to make informed decisions. Thanks for joining me on this journey through the world of inventory valuation and the lower of cost or market rule. I hope you found this information engaging and relatable. Remember, behind every financial statement is a story waiting to be told, and it's up to us to make sure that story is accurate and true. Until next time, keep learning and stay curious.